We're analyzing Sirius XM to see if its market price is a fair value. We're using the Select 6 analysis to look at the most telling financial metrics before estimating an intrinsic value for Sirius XM. There will be a key bonus metric along the way that might be the tipping point when analyzing Sirius XM for your portfolio. A major reason to look at Sirius XM, ticker symbol SIRI, SIRI, is because the company is part of Berkshire Hathaway's public stock portfolio, because it's a subsidiary of Liberty Media, and the company is also in Seth Klarman's portfolio, who reportedly is one of the 3 investment managers that Warren Buffett would trust to run his own money. And with the company at its 52-week lows, well below the price that either of those investors likely invested into the business, Sirius XM may be really interesting to look at right now. Before we get into these valuable metrics, let's understand Sirius XM's stock performance. Sirius XM is currently trading for $3.61 per share. Over the past year, their stock price is down 44%, and since the middle of January of 2023, the business's stock price is down pretty dramatically. Over the last 5 years, Sirius XM's stock price is down 40.5% overall. They're declining at a rate of 10% annually. Over the last 10 years, their stock price is up at a rate of 2.5% annually. And going back prior to the global financial crisis, over the last 18 years, Sirius XM's stock price is down 35% overall. The business is up more than 30 times from its lows in January of 2009, which was after the company declared bankruptcy following the mergers of Sirius Satellite Radio and XM Satellite Radio. The company also pays out an above-average dividend yield of about 2.5%. Their average dividend yield throughout this time frame would be in addition to these compounded annual returns as well. Sirius XM is trading for 20 cents above its 52-week low. The company is down $3 from their 52-week high. Right now, there is some short interest around the business, with about 4% of their shares outstanding sold short, and Sirius XM has a $14 billion market cap. For more background, Sirius XM Holdings is now composed of 2 businesses, Sirius XM and Pandora. Sirius XM transmits music, talk shows, sports, and news via its 2 satellite radio networks, primarily to consumers in vehicles who pay a subscription fee. The firm's radios come pre-installed on a wide range of light vehicles in the United States and Canada. The firm acquired Pandora Music in February of 2019 via an all-stock transaction. Pandora is a streaming music platform that offers an ad-supported radio option and a premium on-demand service. Liberty Media owns 80% of Sirius XM, traded through its Liberty Sirius XM Group tracking stock. The company was incorporated in 2013 and is headquartered in New York. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. And there are 2 key reasons for this. The first is that the average publicly listed business earns about a 7% return on capital. And the second is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. And these business returns will be captured here by return on capital. So by looking for a benchmark of 14% or higher, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. So Sirius XM has earned above average returns in capital in all 5 of these years. They've been increasing their returns since 2019, and averaged out throughout this time frame, Sirius XM is earning about a 28.5% return on capital in a given year. Those returns are 4 times better than those of a typical business, and this is double that benchmark we're looking for, so this is a strong check starting things off here on metric number 1. Next, for metric number 2, we're taking a high-level overview of the growth of the business. So we're looking for revenue, net income, and free cash flow growth over the last 5 years. This metric is all or nothing. Either all 3 of these will be up for this to be a check, or if even one of these is down, this entire metric will be an X. So Sirius XM has had strong revenue growth. They've grown their revenues by 56%. Part of this revenue growth does come from their acquisition of Pandora. The company's earnings have just very slightly grown throughout this time. They're up just 3%, but they are up. And that's a very similar story for their free cash flows. Sirius XM has only grown their free cash flows by 1%, so just very slight free cash flow growth. But technically, across the board here, this is growth on all 3 of these. And so this is a check on metric number 2. Metric number 3, we're taking the perspective of an individual shareholder in the business by looking at Sirius XM on a per share basis. So we're looking for earnings per share growth over the last 5 years for the company. We just learned that their earnings have very slightly grown by 3%. We really want to look at what they've done in terms of their shares outstanding. The company did make that all-stock transaction for Pandora in 2019. But since then, SiriusXM has been steadily repurchasing their shares, and the company has bought back 13% of their shares outstanding overall. So this is important for long-term shareholders in the business, because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. And so when a company buys back shares by decreasing the number of shares that they have outstanding, they're increasing your ownership in the business, which will ultimately increase the percentage of the business's profits that you're entitled to without you having to spend a dime. So it's almost as if the company is making a partial acquisition of itself. And so just like with any other acquisition, we want the business to be getting more value than the price that they're paying. That will depend on a couple of factors, including the price that these buybacks were occurring at, as well as what's a fair intrinsic value for the business, which we'll get to coming up in our analysis. So because SiriusXM has grown their earnings and they bought back their shares, this has led to earnings per share growth, and this is a check here on metric number 3. Metric number 4 is very similar. We're looking for free cash flow per share growth over the past 5 years for SiriusXM. So again, their free cash flows are just very slightly up. They've grown their free cash flows by 1%. And with those 13% share buybacks, this has led to free cash flow per share growth for the business. So this is another check here on metric number 4. And so far through our first 4 metrics, we're a perfect 4 for 4 for SiriusXM. There's still one vital piece missing, however. You might think that nailing high returns on capital and having a growing business is the key to being a wonderful business, but we haven't touched on the one thing that I believe sets truly wonderful businesses apart, which is having these characteristics while not employing a lot of debt in their business. So for metric number 5, we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that the business has produced over their last 5 years. So SiriusXM currently has about a $9.8 billion net debt position, and they have increased this throughout the past 5 years. The company produced $1.5 billion worth of free cash flow in their most recent fiscal year, and overall throughout this time frame, SiriusXM has produced about $8 billion worth of free cash flow, so that is coming in shy of what their net debt position is. So this means that this is an X here on metric number 5, as the company is employing more debt in their business than we're necessarily comfortable with based off of their free cash flows. One thing to note about SiriusXM, as it is a wholly owned subsidiary of Liberty Media, is that John Malone's Liberty businesses tend to employ a lot of debt. However, it's often structured as very long-term debt, and their debt profile can often look pretty attractive, oftentimes not having a lot of current maturities. So with this higher debt load, digging into their debt profile in more detail would be very advantageous as you're learning more about the business. So in their filings, they'll break out how this debt is structured, when it matures, what rates it's at, and if there are any covenants associated with the debt. Again, though, this is an X on metric number 5, and through our first 5 metrics, we have 4 checks and 1 X for SiriusXM. Metric number 6, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will provide us with a slight risk premium to the yield of the 10-year treasury, and it may offer a reasonable starting point for fair value of SiriusXM. We just learned that SiriusXM has produced $8 billion worth of free cash flow over the past 5 years, meaning that in an average year, the business produces about $1.6 billion worth of free cash flow. And currently the business has a $24 billion total enterprise value, which we're using because it takes into account both their market cap and their net debt position, and it's going to give us a perspective of the business that's more similar to as if SiriusXM were a private company. So when we divide their $1.6 billion, their average free cash flow, by their $24 billion total enterprise value, that gives us about a 6.67% average free cash flow to enterprise value yield for the business. So this does look like this is a couple of percentage points above the yield of the 10-year treasury, and so this is a check here on metric number 6. Also worth noting is that the company's current free cash flows are pretty similar to where they've been at historically on average, and so the business has about a 6.45% current free cash flow to enterprise value yield. Just because this is a check doesn't mean that you're going to run out and go buy the business. This isn't a buy or sell recommendation of any security, and it's not financial advice. We still want to perform a discounted cash flow analysis of SiriusXM to come to a more concrete estimate for their intrinsic value. Before we get to that, let's cover our bonus metric that might be that key tipping point. As our bonus here, we're looking at SiriusXM's dividend profile. So SiriusXM currently has a 2.51% dividend yield, which is an above average dividend yield in comparison to the yield from an S&P 500 ETF. Much of that yield is coming from a special dividend that the company had. Although Sirius XM has been increasing their dividend payouts throughout this 5-year time frame. Additionally, the company has also grown their free cash flows, and in all 5 years, it looks like Sirius XM has comfortably supported their dividend payouts using their free cash flows, which is exactly what we want to see here for the company. So while the business does have those high debt loads, and it's worth figuring out how those are structured and when they mature, it would seem like Sirius XM has prioritized returning a lot of capital to shareholders, both in the form of their dividends and with their share buybacks over the last handful of years. While this isn't a guarantee for the future, it does look like their normal dividends are well supported by their cash flows. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Sirius XM, which takes us on to using a discounted cash flow model to come to a potential fair intrinsic value for Sirius XM. So a discounted cash flow model is based off a business's predictability and the predictability of their free cash flows. It's just like any other model in any other discipline, its outputs will be sensitive to its inputs. So here we're starting with SiriusXM's current free cash flows, and we're using historical growth assumptions for how the business has grown these free cash flows over the past 15 years to project these out into the future. If we assume that the business grows their free cash flows at a rate of 11.5% annually for the next 10 years, then during the 10 years out after that this growth rate is cut in half, adding in the company's tangible book value, which gives us an approximation of their tangible net worth per share. If we were seeking a 15% rate of return, which is the rate of return Warren Buffett's looking for from his investments in addition to his margin of safety requirements, then it looks like at today's current valuations that a potential fair intrinsic value for SiriusXM is around $2.70 per share. So that's about 90 cents below what the company's current stock price is at. There are several factors you want to keep in mind here. One is that we would not be doubly counting their dividends, so their dividend yield would be included in this 15% rate of return. SiriusXM has had a high degree of business predictability in its past. That's not necessarily a guarantee for something that would go forward for the company. So that's something that you may want to be mindful of. Then there is the possibility that their book value would be understated here because of how the accounting is done for their share buybacks, especially because they bought back so many of their shares over the past 5 years. So this could be giving SiriusXM less than their due, and especially with this making up a pretty sizable amount of their current stock price. You would just really want to dig in here and understand their accounting in some more detail. Please be mindful of the fact that this type of analysis isn't financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisor. In just a minute, we'll get to our rating for SiriusXM, but we have to address something first. What are some of the qualitative aspects of this business? Starting with some of the key qualitative aspects supporting a potential long thesis for the company. Number 1, SiriusXM enjoys cost certainty on the royalty fee front due to the passage of the Music Modernization Act in 2018. Number 2, Pandora has stabilized its losses on the ad-supported side and should be able to substantially increase its advertising rates over the next few years. And number 3, SiriusXM's satellite radio service and its 360L platform have an in-car technological advantage that the rollout of 5G will likely not deteriorate. Then for some of the key qualitative aspects supporting a potential short thesis of the business. Number 1, streaming services are likely to overtake satellite radio in popularity, potentially causing a spike in churn and a lower conversion rate. Number 2, Pandora will likely be a long-term drag on returns as a path to profitability may not exist. And number 3, Pandora is well behind the market leader Spotify and Apple Music, and music streaming may be a winner-takes-most market. So hopefully that offers a balanced perspective around some of the qualitative aspects of the business. Now it's time for a rating of SiriusXM. So in analyzing SiriusXM, ticker symbol SIRI, we learned that the business earns significantly above average returns on capital of about 28.5%. The company has strongly grown their revenues, and they've very slightly grown their earnings and their free cash flows. The company has also bought back 13% of their shares outstanding, which is a pretty large amount. While the business uses more debt than we're necessarily comfortable with, their debt is likely structured in a very classic John Malone way, so it's worth looking at when this debt matures, as some of these maturities could be very far out into the future. The company does look like it's potentially attractive on both a current and an average basis of their free cash flow to enterprise value yield compared to the yield of the 10-year treasury. SiriusXM has grown their dividend payouts over the last 5 years, and they paid out a special dividend in 2022. The company has also grown their free cash flows, and they've comfortably supported their dividends in all 5 of these years. When we performed a discounted cash flow analysis of SiriusXM, if you've done the work and you believe that those historical growth assumptions are accurate and applicable for the business going forward into the future, and if you were seeking a 15% rate of return at today's valuations, then it looks like a fair value for SiriusXM is right around $2.70 per share. You'll want to keep those factors we laid out in mind as well. So with the business checking 5 of our 6 metrics and their discounted cash flow in mind, it looks like Sirius XM is a very strong candidate for further research. It seems to help that both Seth Klarman and Berkshire Hathaway hold positions in Liberty Media, of which Sirius XM is a subsidiary, and that this current price for Sirius XM would likely be below the price of Sirius XM when those positions were established for those investors. It's worth reiterating that this analysis isn't financial advice and it's not a buy or sell recommendation of any security. Before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. One of the reasons Sirius XM came to my attention was as a subscriber request, so I'm happy to make a video of the company, and thanks for learning about Sirius XM with me.